Hello and welcome to myfinanceteacher.org. Today we are talking about crude oil and its reaction to Donald Trump's tweet, as well as an outlook for crude oil prices over the next several weeks. On Monday, Trump tweeted that crude oil price was getting a little bit too high, and as a reaction to that, crude oil price lost around 3%. However, at the moment, it seems that OPEC is ignoring Trump's tweet and stays on course of tightening crude oil supplies. As a result of that, the price seems to be recovering at the moment. Looking at the chart of crude oil, in mid-February, crude oil broke above the resistance zone of around $56, and over the last couple of days, with Trump's tweet, crude oil seems to have retested that area, retested the breakout, and it seems that the retest is successful. In my opinion, we're going to see probably higher crude oil prices over the next several weeks. And let's have a look at the reasons for that. First of all, normal duration of a daily short-term cycle in crude oil is around a couple of months. We have discussed this duration in the past, link at the top of the screen. Given that the current ongoing short-term cycle started in the first half of February, I still expect several weeks of general upward movement in crude oil price. It's likely that sometime by the second half of March, crude oil reaches the 200-day moving average. This moving average proves to be a considerable resistance zone. That's when we're going to see crude oil decline into the short-term cycle low, probably somewhere into middle of April. This is my most likely scenario. I would give it 60 to 70% probability. On the other hand, we want to manage our risks. And if crude oil price drops significantly and breaks below the 50-day moving average, probably somewhere between $51 and $52 over the next several days, that would mean that the low we saw in early February is not the cycle low yet, and we're going to expect further declines. However, this is not very likely in my opinion. I would say probably around 30% chance of that, maybe even less. Generally, I think the low that we saw in late 2018 is not going to be broken anytime soon, and personally I'm currently holding some USO at the moment, as well as some crude oil producers. Talking about crude oil producers, I want to draw your attention to the PE ratios of some of the largest producers in the world. And these PE ratios are in the range somewhere between 11 to 16. Given that these are some of the largest oil producers in the world, they're unlikely to go out of business anytime soon. In that case, a lower PE ratio is generally desirable, and I think this is relatively low, for example, compared to S&P 500. This is the average PE ratio for companies in the S&P 500. And we see that it's currently above 20. Ratios above 40 or so are quite excessive. And we see a ratio of about 50 coincide with the dot-com bubble top, and the ratio of above 100, close to 120, coincide with the top before the global financial crisis. So the PE ratios of largest oil producers between 11 and 16 compares favorably to PE ratio of S&P 500 on average of around 22-23. So I'm still positive on crude oil price, and I think we might see prices inch close to $60 per barrel sometime in March. So there it is, that's my opinion. What do you guys think? Is crude oil going to break above 200-day moving average or below 50-day moving average sometime soon? Let me know in the comments below, and let's have the chat rolling. This is not investment advice, but I do wish you luck in your trades.